Thank you everyone for being here after lunch or before lunch, whenever you decide to eat. We are here to talk about stablecoins, or we have a fancier title for the session: Stablecoins and the End of Monetary Monopoly, Policy Power and the Battle for Digital Sovereignty. So my name is Sol, I work for Coindesk, I'm head of partnerships for Europe and the UK, and I am joined here by a stellar lineup. I will allow them to introduce themselves, starting by Sean at the end.
Thank you, Sol. Hi, I'm Kiernan, the founder of Greengage. We're a crypto-friendly accounts provider, and we have a private credit lending and yield platform, of which the flagship product is Bitcoin-backed loans.
Thank you, Sean.
Hi all, I'm Azariah Nukajam, Head of Regulation and Compliance at Gemini. Gemini is a global crypto asset exchange, and we offer a range of products including derivatives, staking, and spot trading assets. I've been in the industry now for 3 years, but prior to that I worked in funds and asset management for close to 11 years. Nice to meet you all.
Thank you.
Hi, great to meet everyone. My name is Nkiru. I'm the COO and co-founder at Massa. Massa is a global settlement platform. We provide stablecoin liquidity to licensed payments companies across the globe.
Thank you.
Hi everyone, I'm Dan. I work for Wirex Pay, and Wirex Pay is the non-custodial business line of Wirex, and we offer stablecoin-backed retail accounts, business accounts, and also non-custodial white label card issuing globally, if you want to launch a card program globally. Yep.
Excellent. So we have a very diverse group of panelists here, so I think we're going to have a very interesting conversation about stablecoins. So for centuries, the power and, to create and control money has been a monopoly of the states. Stablecoins in a way challenge that. They sit at the intersection of Web3 and traditional finance, and for many, I think, is the first touch point into crypto. So they promise more efficiency, they promise speed in global commerce, but they also, in a way, force the conversation around regulation, about financial stability, and the very concept of digital sovereignty. Are we witnessing a shift in global monetary power? Let's unpack this discussion. So, Nkiru, from your perspective at Massa, you're building solutions, as you were saying in your introduction, for cross-border payments. Stablecoins are often touted as the ideal infrastructure for global settlements. Where do you see stablecoins having the most immediate, tangible impact on undermining traditional, slow, costly payment rails that financial institutions offer at the moment?
Yeah, I love that question. I mean, I think when we're looking at it from a wider perspective, we often get asked from, let's say, the global north of, well, why do stablecoins matter? I can easily send like a payment, right, in the UK or in Europe. But then it's often forgotten that, well, there's a whole other world out there that doesn't have that infrastructure, and where sending cross-border payments is extremely expensive. On average, you're paying anywhere between 5% to 10% if you're sending from the Middle East to Europe, or the Middle East to the US, or Africa to Indonesia. And half of the time, correspondent banking networks are set up in a way where many of those have delays. Many of those, also don't arrive, or frankly, are just like taking, a T+3 or a T+2. Now, fast forward to in the world of stablecoins, my whole question is like, why can we not reinvent money? It has always been reinvented, and instead of being a blocker to it, we should embrace it, because it's enabling us to send money more real time and more cost effectively, right? If you're looking at even the really expensive gas fees that you might have, Tron's recently gone up, is still significantly cheaper. Like I can send, $2 million for $6. Why is that possible, and why can correspondent banking networks allow for that? And that has to do with the fact that it is set up in a AML, KYB space very inefficiently, and infrastructures like SWIFT are simply messaging infrastructures. They're not tied to real value transfer, and then you still have to settle outside of that infrastructure. I think it's outdated. I think it's not relevant for especially emerging markets in the global south and an interconnected cross-border payments ecosystem. And stablecoins are ultimately the real-time answer to actual value transfer at a cost-effective rate.
Someone said to me on another panel focused on emerging markets and crypto adoption that at the end of the day, banks are charging customers for updating ledgers. Money goes out from one part and gets received in the other. So why costs being so high? And then Sean and I were talking earlier about that time when that money sits doing nothing, basically. Is there anything you'd like to add on that, the fact that people are not really making any profit on that?
It's really interesting, and I think the complete use case we see today outside of the crypto space for stablecoins is developed markets and making those payments more efficient. And in a way, it's a tax on a lot of poorer countries that they're having to bear by using the traditional systems, not just for the inefficiency in taking time, but for the credit costs, really, because that money is sitting, generating interest for people along that chain that's not being used by the people at the either side of that payment. And it's something that we discussed very briefly, kind of, could we get not just the traditional stablecoins, maybe yield-bearing stablecoins to emerge that allow people to move money with some benefit accruing to them? And these are still early, but very exciting developments.
Anyone has anything to add on the efficiency side of things?
More of a regulatory point, less on the efficiency and more on the point around yield-bearing stablecoins. So for those of you that are familiar with the EU rules that came into force under the MiCA regime, apologies in advance for all the acronyms, stablecoin issuers aren't permitted to pass on yield to consumers. And this is a practice that is unique to the European environment, in that in the US and other jurisdictions, it's very normal and much welcomed to pass on that yield to investors, to stablecoin holders. And we are already starting to see a bit of pushback on that front from a consumer outcomes and consumer protection perspective. And in a way, these sorts of practices or policies are starting to be viewed as somewhat exclusionary, because if, let's say, with regards to retail access in particular, stablecoin holders are perhaps deterred from holding stablecoin because it's easier and kind of more beneficial to them to hold bank deposits that pay yield irrespective of how low that is. They are more likely to be inclined to put their money elsewhere, whether it's money market funds or it's traditional bank deposits.
Just maybe the only thing I'll say is that I remember 8 to 10 years ago, Ripple were very, very heavily pushing that they're going to solve instant cross-border payments. And we're like 10 years later, we've made great progress. I think like companies like Massa and obviously you've got others in the industry, whether it's like BVNK or Conduit, they're doing like really great things. But like if someone's going to ask you the question, is cross-border payments going to be instant within 10 years? Like, is it a yes or a no for you? I'm not so sure. I think we'll see, but I'm not, I think there's a lot to solve there, and it's not just as easy as plug a stable coin in. Like the last leg is obviously where it's really important to have like fiat local rails, but definitely the bit in the middle, stablecoin is it's almost already solved. So.
Yeah, I agree that maybe in 10 years, like will cross-border payments be instant? That it might be still like a maybe, yeah. But I do think that has to do with us looking at it from a wider political standpoint, yes. From a perspective of let us be very candid with ourselves. The banks and the central banks want to retain that control for very obvious reasons. So when then a bunch of fintechs come in and the whole crypto community that says, hey, by the way, we're going to move all those funds off your balance sheet, that becomes a problem, right? So I don't believe it's a question about like, from a thesis perspective, can we make this happen technologically? We can. It also isn't about can we drive adoption and like make regulation and protections and put them in place in order to serve everybody. we can. And surely the last mile, at some point in time, if you look at emerging markets, many markets from Indonesia, Nigeria, etc., when it comes to consumers, 500 million holders of Tether currently exist. And if you look at where that is, that's Argentina, that's Indonesia, that's Philippines, that's Nigeria and Kenya, for very obvious reasons, which is access to the US dollar is extremely finite within those markets. So being able to access that and being able to hedge against your own currency is extremely attractive, especially if you have diaspora communities that rely on that cross-border payments at a cost-effective rate, right? So I honestly believe that this is more of a, if we don't achieve it in 10 years, it has to be down to banks, governments, and regulators that are frankly making it impossible.
Thank you. Continuing on the adoption side of things, I wanted to turn to you, Daniel. On as Wirex focuses on non-custodial technology, so that means that it gives control to the individual, which at the end of the day is what crypto is all about. It's about making individuals sort of owners of their money. So what do you think in terms of education that it's needed for this adoption that Nkiru was also talking about?
The pros and cons. So I was on holiday recently and I lost my phone. And when you find out you lose your phone on holiday, like in that moment, I didn't care that I had like some sensitive photos or pictures in my, like on my phone. I didn't care about my banking apps. What I immediately cared about were my self-custodial wallets, and only because it's like quite, you can go wrong in so many different places if you've like not, your OPSEC isn't that strong. So, that was probably the most important thing that you need to bear in mind with self-custodial finance, is that if you mess up, you're entirely on the hook. But the pros of it, and I think it's such a on-trend topic at the moment, is this kind of stablecoin banking meta. One of the things that we do at Wirex is we allow you to have stablecoins as spendable assets through a card. So we link a debit card, and that debit card is linked to your self-custodial wallet, MetaMask, Trust, whatever you want. And suddenly, your funds are now spendable anywhere Visa's accepted without needing a bank account. Now, okay, here in the UK, like you were just saying, it's not that big a deal because your banking infrastructure is really great. You've got like Starling and Monzo, and like, why would you want to link it to an external wallet? But in other jurisdictions, where you have like capital controls or raging inflation, you might actually prefer to spend your balances from your externally owned wallet. So I think like now we've got a real use case of having assets stablecoin linked. They're in your control. No one can do anything with them other than you, and they're spendable anywhere, anywhere in the world, really. So
I think it's great because we have two very real case studies on what you've mentioned earlier about cross-border payments, particularly to facilitate international trade, and the consumer side of things that you've just pointed out. So, and yes, I mean, for those who don't know me, I'm originally from Argentina, and in my long life, I have seen several crises, and I have seen inflation going crazy. And I think the reason why in countries like Argentina or Nigeria or Turkey, crypto is, gaining so much adoption, in a way, to access the collateral, which could be, I don't know, the US dollar, but also as a hedge against inflation as well. When you have capital controls and inflation, it's it's a perfect combination to adopt crypto. So that's why I'm always interested on what the users need to know. Shan, I wanted to turn to you. This isn't a panel on regulation, but obviously stablecoins regulation, it's something that we need to mention here, particularly with the recent developments in the US with the Clarity Act. Do you see, I mean, the developments that we have been having in terms of regulatory frameworks, do you see those as fostering adoption or flying into less restrictive jurisdictions?
I'm going to be pretty bullish on the Genius Act in the US. I think this is a US dollar game right now for stablecoins, and it's actually the killer app, if you will, for getting our traditional world to meet with the digital world, in that 2% of dollar flows are now done on the stablecoins globally. Like, this is massive. And for the US to formally recognize that at such a regime where the federal level law is now set to enfranchise is an unlock at levels beyond just the developing market use case, but also at an institutional level. And if we want to get that to be not 2% of dollar flows, but 100% of dollar flows, we need institutional participants to play. And that means finding reasons for developed market users to engage with stablecoins or private company stablecoins. And I think yield-bearing instruments, the ones we've discussed that are still early, will be one of those big unlocks for retail, but also for institutional players. One of the things we've been intrigued by is private credit and the whole yield creation piece. And if you're able to have a wallet and you're normalized in behaving with a wallet for making payments, it's not that much more of a lift to think of, how do I use this wallet for other things? And so we've been doing some pilots with, we did one with Coinbase to tokenize private credit and see end-to-end life cycles for moving those loans in a smart contract that can settle atomically because you have a wallet, you don't have a bank account, and so you can't have that with a traditional bank account, movement of funds that happens with a smart contract. You have to get people to press buttons, and there's a lot of costs in that you can take out of the credit creation cycle and hopefully get funds costing less. And traditional markets, more broadly, say capital markets, could also benefit from these mechanisms.
I think just picking up on what you've said earlier about being bullish on the Genius Act and what's happening in the US. Don't you see that also as a way? I thought that the US government was quite clever in the sense that they established the US dollar as the collateral for a stablecoin. So in a way, they also helped that dominance of the US dollar prevail.
And it's something that they had to do. I mean, the US Treasury needs more funding, so they have to lean into this. And it's something that the rest of the major reserve currencies are going to struggle with. Because, I mean, we sit in the UK. If the UK doesn't have a sterling stablecoin, it will need to create something that allows for money to still come into sterling to help offset the cost of borrowing, which is now a feature of the Western economies.
So where's the UK version of the Genius Act? Where is it?
Good question.
Where is it?
Yeah.
Azariah, yeah, where is it?
I need things to move a little bit quicker. But I wanted to move to you, Azariah, and I wanted to, given your experience on anti-money laundering and you know, all the compliance aspect of the business as well, what do you think is the most significant gap today on stablecoin regulation concerning financial crime specifically and consumer protection?
Okay, I will come back to the question on where we are with stablecoin regulation, a Genius Act equivalent, if I have time right at the end. But with regards to your specific questions around financial crime and the gaps between the DeFi and centralized finance space, I think that, so there are a couple of things. For context, firms that operate within the centralized finance space are subject to a raft of anti-money laundering requirements, and they include KYC, which is the requirement to identify and verify your customers. There are sanction screening obligations, so that parties, let's say in-scope firms, have the ability to understand the risks posed by any sort of entities or individuals that they enter into business relationships with. There are also rules around the identification of originators and beneficiaries of crypto asset transactions. And all of these requirements that apply to centralized finance rules serve the key purpose of essentially not only protecting businesses from bad actors and being kind of caught up in illicit activity, but they also support law enforcement agencies, governments, etc., with their broader agendas and objectives around prevention and management of financial crime. Most of these centralized finance firms that are subject to these AML or anti-money laundering rules tend to sit at the gateway between DeFi and centralized finance. They act as your on and off ramps, for example. They act as your custodians. And on the front end, if you will, it's not easy. I would say it's costly, but it's fairly straightforward to be able to manage those risks around anti-money laundering. Where it becomes more tricky, however, is that these very same rules that I mentioned that apply in the centralized finance world do not apply to DeFi. DeFi having a sort of broad definition within the regulatory and legislative framework as being transactions and activities that are either isolated to protocol only interactions or transactions where there is no identifiable party that is in control of a particular function, or where there is no party that in a way serves the purpose of an economic function. And you see this in practice where self-hosted to self-hosted wallet transactions are made on the blockchain, for example. In that realm, in the DeFi realm, these anti-money laundering rules do not apply. And so there is a slight friction there between the centralized finance activities and the obligations that those in-scope firms or entities have to adhere to versus the application of those rules extended beyond the centralized finance perimeter and into DeFi. Of course, there is lots of buzz in the media, in the news, etc., around financial crime within the crypto space. But the reality, at least from reports that we've seen, such as those published by Chain Analysis, excuse me, show that illicit activities only make up 0.14% of activities within the crypto asset ecosystem. And although very, very small, those activities themselves tend to be, I guess, highlighted in a way. Sorry.
Yes, I agree. I think, however small
yes,
they don't get a lot of press, but they should still be prevented.
Yes, so that puts a lot of firms that do have these financial crime obligations under heightened pressure to ensure that at the access point, at the DeFi access point, they are applying AML obligations and practices to manage potential risks of potentially illicit activities that occur on the DeFi, within the DeFi ecosystem. Sorry. Sorry.
Nkiru, you wanted to add something.
Oh, sorry. And I'd say in the last year or so, the regulators and legislators, policymakers have essentially said that firms that are subject to the AML rules but that interact with the DeFi perimeter should be upholding certain best practice standards to ensure that, and I'll share some of those in just a moment, to ensure that they are able to capture some of those risks posed by illicit activities that take place within the DeFi environment. And they speak to a requirement, for example, to screen counterparties and wallets, identify them for bridging exposure, privacy enhanced protocols, etc., and decide to apply enhanced due diligence.
There are processes and frameworks that can make sort of this preventable as well. Nkiru, sorry.
Yeah, I find this topic, of course, important and fascinating, but also extremely comical, because there's been more scrutiny in the crypto space and stablecoin-related payment space on basically AML and like sanction screening and you name it, than or you can actually hold water to in like traditional correspondent banking. Because, again, back to the notion of Swift, Swift is a messaging platform. So please tell me how exactly, because somebody input a message, that you can validate that the origination of the actual funds and value is 100% not, you know, how do you say, in any form illicit. It's been a really, really difficult things for correspondent banking. A lot of times, like traditional media is overlooking that and is overlooking the complexity that exists actually in our existing, you know, infrastructure and actually the harm that's done on that. Backwards in back in 2019 at Cybos, I remember being on a panel and discussing this with, you know, an entity that was focusing on reducing poaching. And the fact is, that everybody in the banking ecosystem that was on that panel offline said, you know what, there's no way we can assure that this is not happening over like traditional infrastructure. And so it is really something we need to take a look at, because if you talk to like private investigators, like criminal investigators, every single one of them will tell you they have had more success seizing assets on-chain than they've ever had doing it off-chain in traditional infrastructure.
Sean, I wanted to ask you, do you feel that operating in the crypto space, you face a much higher level of scrutiny from investors?
Much higher, sorry.
A higher level of scrutiny
yes,
from investors.
Yes, in principle. I think there's two elements of risk. We spoke about the AML piece, which I think the industry is actually held to a higher bar than traditional finance because there are more tools available to interrogate. I mean, the blockchain is traceable. You don't have that with SWIFT to see the whole life cycle of where money moves, whereas we see the constellation of where money moves, including various hubs from previous wallets, for example. And in terms of the broader investment space and the risks that firms like us have, and we're not actually regulated ourselves. We work with banking as a service partners for the payments piece, and the lending that we facilitate is B2B, so we're kind of outside of the perimeter. Nevertheless, we always get asked, are you acting to the right standard? And to do that, and part of who we are as a team, being mostly ex-bankers, is we still fulfill full requirements, and then we work with partners to double up on that, if that makes sense. So we're not doing this as if we're an unregulated entity. We kind of have to almost double up on that level just to survive.
I think the problem with crypto in particular is that, unlike traditional finance, where this concept of adopting a risk-based approach is really well understood, and there are guidance and precedents set for the standards that firms in that space need to uphold in order to manage their risks, I think within the crypto sector, that concept is very new. So what you find in an attempt to be compliant is that firms, may not be well positioned to say this, but firms end up adopting very extremely costly infrastructure and tools that do not ultimately serve the purposes that they suggest or think they might serve. And I think there is perhaps a need or a requirement for additional guidance for crypto asset players as to what that risk-based proportionate approach looks like. Of course, there are obfuscation tools that operate within the blockchain that makes it, I think you mentioned just a moment ago, the idea of hops, cross-chain bridging, etc. There are lots of ways in which you can hide the origins of transactions, but the reality is, one, they are visible on the blockchain, and if law enforcement want to trace those, they should make that their responsibility. There should be a bit more of an onus on them to equip themselves with the tools they require to adequately supervise.
Daniel, is there anything you would like to add from the Wirex perspective in terms of your user onboarding?
Look, Wirex is a regulated business, so I completely relate to some of the challenges that you're talking about. Obviously, it's not just enough to use elliptic or Chainalysis. Like, you need to use it in the right way. It's not just a rubber stamp that you just start working with these businesses. It means like there's nothing bad or insidious going on in your business. So, look, all I'll say on the other point is that most banks you can walk into with a large sum of cash, no one's going to ask you any questions about sending that anywhere. But on the digital asset side of things, like, you're immediately scrutinized and you immediately have to pass checks. So, yeah.
May I add just one comment on consumer protection? I'm pro-consumer as far as crypto is concerned. I think one thing that the UK and the European legislations or regulations haven't yet addressed is the idea of a redress, some sort of deposit protection, deposit guarantee style scheme for stablecoin holders. If we are to treat stablecoin as an exchange of value and a means of payment in a way that is similar to cash and cash equivalents, I think that there should be some sort of consumer-friendly scheme for to protect consumers against loss.
And at the end of the day, aside from sort of financial crime protection and all that, the role of the regulator will always be to protect the consumer. We can have a whole other panel talking about consumer protection. But thank you for bringing us back to the stablecoins theme, which is what we are discussing here. I want to mention, we talked about Genius Act. I want to mention CBDCs and whether they seem to be the natural evolution for the state to continue to control money. But do you see them as coexisting with private stablecoins, or do you see them as a threat? This can go to any of you.
CBDCs, very interesting topic. Very polarized topic, actually. I think a couple of things to note, right? It's like the role of money, you have to question who is it serving and why. And so if you ask anybody in this crowd, how much control do you want to give up on what is actually rightfully yours? However you obtained it, right? But it's yours, and that is money. The question is like, how seizable do you want that to be? And so the role of private money is very important. And I think we're getting to this digital age and this control state as well, where it's really, really important for us all to question that and being like, how controlled do I want my money and my funds to be, and why, right? Because we always see it as like a positive. Oh, governments are there to protect us. Oh, governments are going to do the right thing. Well, history teaches us that that's not always true.
Depends who you ask.
Yeah, exactly. It depends who you ask. I mean,
well, let's ask the audience, who thinks CBDCs are good or okay and are fine, and who thinks they're bad and terrible and we should run a mile? So let's go for the first. CBDCs, okay in principle. One person, two people, okay. And so, okay,
I think we know.
Well, you know what? I'll challenge you guys, because like CBDCs come in, I think all of you in this crowd will use them. I think you would. I think you would. Okay, maybe one. Okay, maybe you're very against it, sir, and I respect that, and I'm sure. But the vast majority would, because if it's tied to something that, you know, some like digital identity, and you can pay your tax, and it's going to make it easier. We're all early adopters here, right? Most people will do it just out of ease, out of convenience.
But
they'll
are you
do
sure
it.
because of ease or because it's mandated?
Sorry, mandated. Yeah, sorry, absolutely.
Those are two different things.
Yes,
like
and
being mandated and saying this is the only currency that holds value and the only currency that we will transact with.
Sorry.
And by the way, the banks also have an equally big issue around CBDC for multiple other reasons, right? To the extent that even SWIFT, like when they, before they published a white paper back in like 2020, I think it was, or 21, had a very big debate about like how applicable are CBDCs, because it is really polarized.
Yes, I think though it's less unlikely that the monetary authority will upset the banks too much, considering that they are their counterparties. But you know, we will see what the future holds in terms of digital money.
Sorry, I just want to say one thing, is that my question was based on the fact that they would be mandated. So yeah.
Mm-hmm.
I think you asked the question of whether it will pose direct competition to private stablecoins.
Correct.
And I think in their current form, CBDCs won't, because in order for them to compete with private stablecoins, there must be an appetite for adoption, right? And I mean, there has been numerous research papers, including those undertaken by the ECB, that suggests that everyday users, retail individuals, are very much averse to the idea of CBDCs for a variety of very valid reasons, including the privacy risks associated with them, surveillance risks associated with them. There is the issue of control. CBDCs ultimately are programmable, and in that sense, the government, being the issuer of the CBDC, can create some sort of smart code that controls your usage of that money. And those are all, I think, really valid concerns that need to be addressed by governments. I think we talk a lot about this idea of trust. Money is a trust thing, and unless governments evidence and demonstrate that they have the interests of the people in mind when they create these policies, I don't know.
I understand your concerns. Ron, did you want to add?
Yeah, maybe just to add, I'd be surprised if central banks really push out retail CBDCs. As of today, they're not themselves doing money laundering checks. They rely on the banks to do so. And if they had direct access to consumer accounts, I think that liability would not be something they could push out into the ecosystem anymore. For traditional finance, they'd have to take it on their own backs. And I can't see central bankers wanting to have that liability. Maybe the wholesale use case, but I'd rather see CBDCs, if they do happen, in the context of a wider diversity of payment rails. Because I think private stablecoins make a lot more sense, particularly for retail, but also for institutional, because you have more flexibility.
Much more flexibility, that's true.
And just one last point to add is, you know, you mentioned to serve the people, right? But who are the people? And this is, again, back to political question. It's like we're not a uniform, like, people. Like, politics today is so polarized, and when you make money suddenly aligned to politics, that can go wrong really quickly. And who does it represent,
yes,
right?
and everyone is a lot more sensitive when there is a monetary interest. I'm getting lots of red flags. I have to stop. I'm sorry.
Thank you so much.
I'm sorry, but thank you very much for sharing your thoughts. I feel that we could have done another half an hour or our entire conference on stablecoins. Your insights were super helpful. Hopefully the audience left more, or is leaving more educated. Don't go anywhere because there's more content coming up. Please join me in thanking my panelists, and you will find them at the conference.
Thank you.